Welcome to today's lecture, and as you can see, it is the last lecture of the series. We are going to be going over some live data that we went over on the live markets, and I will see if I can attach the live data and evidence from the movement onto the video. But if not, that doesn't matter. The point was there was these London highs and these Asia highs that we're resting. We do the 950. I'm sure we've all noticed that from the moves that we take during the backtesting session. So obviously at 9:45 here we had this candle. Right, it was a 15-minute candle, which failed to close above here and above here. So we didn't have a break of structure, but rather we had a sweep. Then we have this candle that took out London highs, and within that candle, I believe I took it off the 2 minute. There was an inversion. I mean, no, there was the 3 minute inversion. There we go. So this 3 minute inversion played out here. I entered on the inversion, and I learned something. Obviously, this is now for the finals. When you're entering inversions, you want your stop to be at the high of the inversion candle. So this fair value gap candle, it's high, or if you're short, it's low. One thing I've noticed is that the candle is the same with fair value gaps. The candles can actually take the whole range of the fair value gap or the inversion, but it can never take out the high of it. For some reason, it never takes out the high of that. So it's an effective measure to have, especially if you're trading inversions. So I shot off that, and I took shorts. My aim was to obviously take out this SMT, but then we had this fair value gap here that price reacted off of, and it made sense because I don't know if we had in the last lecture, but sometimes price will go to the -1 and then reverse if there is liquidity still above us. So it's either there's liquidity within the range or liquidity above us, and that's what we had here. We had price take out Asia highs, so it reversed, took out Asia highs, and after taking out Asia highs, it gave us the full range down to that low we were looking at. So it was very unfortunate for us that we had to get stopped out before the entire event, but it was a big lesson. In fact, I was on a 190 rands account. I was floating above 1,100 by the time price reached here, but I genuinely thought we'd take out these lows, so I kept it running. I had stop loss somewhere at break even, and then I made some profit, but then I tried taking another short, thinking that maybe we'd react off of this market such a shift instead, but then got tagged out for the whole account. So it's no sweat. We'll try again when the time comes. And that's pretty much it. Took out the whole range, and it was great. The setup was beautiful. This would be a nice setup to take from PM. I think PM weekend is like 15. It's like normally I think it's like from 1400, like for ICT traders. So it's like from somewhere here, right? But I see there a lot of consolidation. We do have a market such a shift here, and then let's see what the 5 and 15 minutes were giving at that point in time. Yeah, took out the local level. All right, after taking out the local level, that would be a good reason to get down to the 3 and 1 minute and see what's going on there. All right, we took out a level, then that level, this high fails to get. Oh no, it gets taken again. This high takes out these highs. Then we have that market structure shift. Then we have price retesting really far back. As you can see, there's no fair value gaps whatsoever. So you'd really depend on the market structure shift. Entry here, stop loss at the highs, and then taking that short right down to complete the range. Obviously, maybe if you were skeptical, you would first take some partials off at the 50% of the range and then leave the runner for the rest of the range. But I'm not really a partial trader. I take out the full range. So yeah, this could have been avoided if as you can see here, there was an SMT with silver. A very beautiful SMT right there. So it could have been avoided if we were looking at silver. I was on a hike, so I was using data and I was just focused on one chart. I only marked out this SMT, but on silver we took out this low. So it would have been a great sign if I was watching silver as well. Then we'd have been able to notice how we took out that low, and yeah, we entered the fair value gap. So liquidity was represented in different ways. So maybe after seeing that, obviously with the help of silver, I would have been able to close out at the slightest inconvenience, because I'm sure on the 1 minute it already gave signs of a changing structure. But like I said, I was on a hike, so it was very difficult to see, right? So we do have this inversion that was created here. So I'm sure that by the time price reached here and then broke below and started seeing resistance here, I think it would have been the best idea to bring all your stops here. That's one thing I can advise you guys. If you do see a lot of resistance, like prices failing to close below the lows or failing to inverse the fair value gap, best to tag the most recent high or low just to be safe. My stops were all the way up here. So when I reversed, I made like what, maybe 80, 90 rands profit, but then tried to take shorts again and got tagged out. So that's a big lesson right there. And I'm having these on video, so like I said, visual representation. I was going to write them down in my journal, but I thought, no, it's going to be useless if I can't visually represent what I'm talking about. And that's pretty much it. In the event of backtesting and whatnot, I have come to a conclusion and an end of it. We've had really good results. I can't lie. We've had really good results, and now it's come the time to build live data, right? So that's the reason why I'm moving away from backtesting. We've really spent a lot of time working on it, and yeah, this is obviously my win rate ever since the dawn of time, so don't mind it. So yeah, we've spent a lot of time, we've made a lot of progress, and I believe that's the reason why we're ending the series off here. Really, we've done a lot, and we've made a lot of progress, and that's gonna be the conclusion of the series. The rest will just be, once I get a funded account, I will be recording the live performance. That way we can kind of get the cogwheels behind why I do what I do. But the main takeaways from this last lecture is highs and lows of fair value gaps and inversions can be used as stop points. They are very trustworthy. Trust me, it's not only this trade, I've seen it many a times. All right, and even when I used to look at other traders, I used to wonder why they would just put their stops randomly. All right, they're not at the high, but then I realized that there's a very good strength, because in this one candle, there is a high and a low, whatnot. Even in this candle, there's, if you look on the 15-second or 30-second, there is a swing that's been made there. So that, according to price action, how price action works, it wouldn't be natural for price to violate it. So yeah, that's pretty much the same way. Like, you see this candle, even though it's a fair value gap, within this candle there's a low, and we can see the representation rather on this candle, right? So I'm sure ICT's had a video of it, where if half a fair value gap has been filled, then from that point it's been filled to here is a new fair value gap in a sort. Like, I'm not making this up, I promise you. I'll try to get the links in the description. I'm sure I'll get the links in the description where I can, if I get the time to just look over the videos. But yeah, this is kind of like treated as its own fair value gap. But I don't look at it that way. I look at it as one is liquidity, the other is a fair value gap, which both represent liquidity in any way. So yeah, as you can see, it also greatly aligns with the -1 deviation, which is a common retracement point. But in this case, for our case, it was a reversal point based off the position we entered from. It was a good retracement point for, in terms of bias, retracing to liquidity, and then obviously continuing forward. But in terms of here, it was a actual reversal. But it was a great position. And with that, that wraps up the episode and wraps up the series. I really hope you guys enjoyed it, and now let's move on to live performance and actually put the skill to the test, because there's a very big difference between classroom knowledge and live game day knowledge. And as you've seen there, we built a lot of lessons just off one trade from game day knowledge. So that is going to be the approach here on out. We're going to be assessing more trades, like prior to when I get my funded. If I take live accounts, we'll be assessing them post trade, and then live funded, we'll be recording as we go, as we trade. So that's pretty much it, and I bid you all farewell and have a good day. Peace out.